Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and global capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright, Mark Marex, Senior Director of Index Research and Development at Nasdaq Global Indexes, as well as Joshua Joffe, Head of Investments at Revolve Wealth Partners. We're here to discuss asset class rankings as U.S. equities retain the #1 spot. It is great to see all of you as always. And Chuck, this seems to be the narrative that we've been in for quite some time now, that regardless of all the headlines in the markets and some of the unknowns, U.S. equity is still the place to be right now.
Yeah, it is. I feel like a broken record because I feel like it's been this way, for most of the last 3 years, but it is what it is. You just have to go with the trend, and the trend is firmly with U.S. equities. Probably the last time we spoke in mid-January, we were in a bit of an oversold condition in the market, at least with stocks kind of underneath the surface. Even though the market itself didn't feel very oversold, the average stock it kind of was. And that really hasn't changed, but so much. I mean, the market has obviously rallied back. We're, probably up about 2 to 3% off that mid-January low. But still we're in this kind of situation where the average stock, let's say in the S&P, is still about 15% off of its high. And so, a lot of people call that a breadth divergence. Where the average stock isn't kind of keeping up with the market as a whole, and that can be worrisome. I think we talked about it last time, where these kind of conditions tend to precede kind of steeper bull market pullbacks, kind of more in the 15 to 20% range versus the 10% that you usually see. It doesn't mean that it has to happen, but it's kind of like the window's open for it to happen if it wants to. So that we're looking at that as a potential downside. But on the whole, obviously U.S. equity is still #1. The trend's still good. So all the long-term things that we typically look for are in place.
Yeah, and Mark, that really has been the narrative over the past few weeks when you look at levels in the S&P or in the Nasdaq 100 in terms of what's the catalyst for the breakout either way, right? But if we isolate it to earnings, they were quite good. They were in line thus far reported.
Yeah, it's definitely been an interesting start to the year. January, I thought was pretty choppy, even though volatility was pretty subdued overall. There was this kind of mix of a lot of days where the market was up 1% or down more than 1%. Some of that was driven by earnings related volatility. You had kind of a mixed bag with some of the biggest names in the Nasdaq 100 in terms of earnings, and specifically not so much that they missed. Generally speaking, Nasdaq 100 companies have exceeded expectations this earnings season by around an 80% hit rate. That's better than the recent historical averages in terms of the beat rate on earnings. And year-over-year growth has come in on track to come in 23% this quarter, which is quite a bit ahead of the broader U.S. large cap space. That's been the story for the last few years. But again, you had a bit of a mixed bag in terms of names like Microsoft and Google. When they reported earnings, despite beating, it wasn't quite the level of beat that investors maybe had been pricing in. So some of those bigger names were down, and then you had other names like Meta Platforms and Tesla and Netflix that just absolutely crushed it in January. And so that definitely drove a little bit of that choppiness. We seem to be past the peak of earnings season at this point. We've only got a few big names left, like Nvidia next week.
Yeah. And Josh, when you think about it, when you report fourth quarter earnings in the first quarter and you have to do that full year guidance, obviously your insight is going to be a little bit less than it would be as if you're in the fourth quarter reporting third quarter earnings, when you have a little bit more insight, right? So it's kind of typical in the first quarter of the year as these earnings reports are coming out, that guidance might be a little bit light just because of the seasonality. But then again, the operational environment right now, it's hard to understand what that execution may look like with a number of those outliers.
Yeah, certainly, Jill. There's a lot of uncertainty, right? And I don't think executives have even been, mentioning tariffs and the potential impact that could have. But I think we've seen this for a few years now, where companies continue to perhaps issue more cautious guidance, and then they continue to beat that low bar. And just looking at Q4 earnings as an example, we're up nearly 17% year over year, right? Highest rate since 2021. And forward estimates continue to be strong when we look out to 2025 and 2026, analyst estimates, that is. So in our mind, corporate earnings and profit margins, which continue to accelerate, those are really what's been driving this market. And we are constructive. We think there is reason to be optimistic that it can persist. Certainly, right, we're seeing a bit more caution. Certainly, we wouldn't be surprised if there was some consolidation as the market digests some of these headline risks. But the story's been, right, resiliency, and we continue to make new highs. We're in a bull market. And I think as long as that earnings story persists, this can extend a bit longer than people assume.
Yeah. And Josh, another theme that we're hearing with strategists coming on the show is it's broadening out beyond just the tech theme. And there are other sectors that are worthy of looking into for other ideas that perhaps were untapped over the past couple of years. Are there other areas within the market outside of tech that you think are interesting at this point?
Yeah, absolutely. And this is a theme that we've been talking about at Revolve for a few years now. For this bull market to really have legs, I think we do need to see it broaden out. We do need to see that expansion, that sector rotation. Obviously, big tech, the Mag 7 has carried so much of the return going back now a few years, but we do see some encouraging signs. Even just looking at the percentage of S&P 500 components that are outperforming the index, it's steadily getting higher. There's still, as Chuck mentioned, still a lot of room to go. But we certainly see some encouraging signs that it's not only, right, big tech. Tech has surprisingly underperformed the market, right? If you go back to July, even semiconductors within tech have surprisingly or quietly perhaps underperformed. But, financials, industrials, materials continue to lead. And we hope to see more of that. That's a great sign for a bull market. And even going beyond just, U.S. large caps, we're constructive on small caps, mid cap stocks. I think we're starting to see some signs. International equities have actually been leading year to date. We'll see if that can persist. But for globally diversified investors, right, who are following diligently an asset allocation program, I think for the first time in a long time, you're beginning to see a lot of those benefits. And we do think that this notion that, if the Mag 7 were to sell off, it would take the entire market with it. Well, it can go the other way. We can see a bit of a reset, and we can see the rest of the market actually begin to keep pace and outperform, and that would be quite healthy and constructive in our view.
Yeah, I mean, just look at the very, very short-term scenario of DeepSeek and how it wasn't necessarily so impactful on the market as one might have expected. But Chuck, this is a perfect segue for you. International markets, that really has been the theme for 2025 because, since the beginning of the year, the risk really was to the upside, considering, how beaten down they've been in their valuations relative to what we've seen with large cap in the U.S. markets.
Yeah, yeah, and they had been doing so poorly they had dropped to number 3 in our asset class rankings. But yeah, have come on strong this year, as Josh mentioned. They're the top performing asset class for the year, up about 7% or so. And the returns have been fairly broad. It hasn't just been like in the U.S. you're used to thinking like we've mentioned that the Mag 7 kind of leading the charge. They've been fairly broad from a regional perspective on the international scene. Latin America I think is up about 14% already this year, and even Europe by itself is up about 10%. And so, yeah, it's not just certain small areas of the market that are leading the charge. It's pretty much across the board. Even emerging markets, they're up more than the S&P this year. And with Europe, some people have said that it has to do with they have less exposure to AI, and there's all this worry that we've kind of overinvested in AI. That could be part of it. Also that their valuations are just lower, so they kind of been due to rally anyway. They just needed some kind of catalyst to do it, and that might have been what it is, but. It's an interesting thing to see. I will say they've mostly lagged for the last 15 plus years, and so every once in a while you get this kind of false dawn, and I'm a little worried that that's what this is because I've seen it probably at least 3 or 4 times since then. But you never know, that false dawn eventually turns into a true dawn, right? So we're hoping that that's what's going on here.
Yeah. Mark, let's spend more time with the AI related news and how that's impacting the index. And we've gotten quite a bit of it since the beginning of the year. I think the index has been quite resilient and was able to absorb a lot of this news.
Yeah, Jill, I mean, I think the one word to summarize the pace of innovation that we're in the midst of right now with AI is exponential. The advancements that are sort of coming out, the top tier, the frontier model developers in the US and now to some extent in China as well, with not just DeepSeek, but Alibaba making some waves recently. I mean, there is tremendous amount of advancement in the overall sort of efficiency of model design that we've seen recently. DeepSeek was sort of a leader in that, but turns out a lot of the frontier model developers in the US were kind of moving in that direction anyway. This takeover from, a focus on spending a ton of resources on training models up front to, deploying them and then running a lot of ongoing sort of inference related compute spend to run them going forward. I mean, it's been, I think, a dizzying pace of advancement over the last couple of months, and we've shifted very abruptly from, if you remember, towards the end of last year, the concern was, where is the ROI on AI spending, right? It's expensive. What are you going to show for it? There's not much to show for it. Now, all of a sudden, everyone's realizing there's a huge, steep decline in terms of the cost curve of how much it's going to cost to roll this out to more and more use cases in a much more accelerated timeline. DeepSeek was just one very small part of that story, and it really impacted NVIDIA and to a similar extent Broadcom, because those are the two big names in terms of AI semis and in terms of receiving all of the AI CapEx spend. But when the DeepSeek news came out, Meta was up, Amazon was up, Apple was up. They each have their own level of exposure to higher earnings if the cost to deploy AI goes down and it gets easier to do so on device and in a lot of different ways. So it's been fascinating trying to keep up with the pace. I think this year you're going to see a lot of progress in terms of deployment of AI in real use cases with some of the agentic solutions that are coming out.
Yeah, and Mark, I would agree with you there. I think it would be naive to say that quality management teams, top tier teams at NVIDIA, Qualcomm, the other companies that you had managed, if they did not anticipate these scenarios and had to adapt in those environments, it would be naive to think that they haven't considered this when they're, doing their risk analysis and thinking about the competitive landscape. So I would agree with you 100% there. Josh, I think there's something else that Mark had mentioned that sticks out to me as well, how quickly the narratives have changed. I mean, if you look at the DeepSeek news, it was less than a market session that we kind of, got through it and figured it out and people were buying the dip. And it just seems as if trends or news cycles are happening within sessions, days, perhaps a week. It's no longer taking a month or quarters to play out, which I think is fascinating in an environment like this.
Yeah, absolutely. I mean, that the pace at which the news cycle is moving, and DeepSeek's a great example. We saw the news really come out over the weekend, and it didn't take the market very long to absorb it and to reprice and to reset. Things are happening so much more quickly, and I think, to Mark's point, in terms of AI, it's no longer just about semiconductors. The story is a lot bigger, and I think we're beginning to see that through other industries. We're beginning to see some of the potential implications. It's not only going to be NVIDIA that's going to be the beneficiary, right? We're going to see how other companies continue to leverage a lot of this innovation, continue to improve productivity, continue to realize greater profit margins as a result. And it's playing out in front of our eyes. And I think it's really exciting just to see unfold.
Yeah. And Josh, when you're speaking with clients, because things are happening so fast, and what you're doing at Revolve is trying to think about futures, imagining that future, building longer term wealth. How are you advising them in terms of how to ride out the machinations in the market and to be mindful of that longer term goal? What are some of the concerns that they share? What are some of the ways that you're advising them in terms of portfolio construction and sticking with the themes that have been working? What does that look like?
Yeah, a lot of it is just, I think, really anchoring to what has worked historically. So, things are definitely moving at a frenetic pace. There's headline risk. We're beginning to see some cracks, but that's always been the case. The details have changed, right? But the narrative is consistent. There's always going to be, looming innovation. There's always going to be threats, whether they be, geopolitical, whether they be monetary, right? These are consistent themes we've seen over and over again. And what we know is, historically, right, we know markets are cyclical. We know that diversification, right, can be beneficial. So we're really trying to focus on a lot of those elements that are still within our control, so we don't have to, be ahead of, the vast array of possibilities that can emerge from one specific theme, like AI, as an example. Right now we're seeing a lot of opportunity, frankly, in a lot of segments that have been overlooked, perhaps. Fixed income, right? We're a lot more constructive. We mentioned international equities. We mentioned small caps. We're looking at value. So I think just, really being mindful of valuations today, really being mindful of some of the perhaps overlooked opportunities that are still compelling, and focusing again on what has worked historically, despite the fact that, things seem to be happening at just such a frenetic pace today.
Yeah, and that's great advice. And to wrap up here, Chuck, anything within the asset class rankings that stick out in addition to what we've seen on the U.S. and international equity front?
Just commodities are still at number 2, which is, energy kind of got them up there with the move that they had the previous month. They pulled back pretty hard last month, but there's still some strength there. And you've had the precious metals move that we've had, this year, and really most of the last year has just been, phenomenal. Gold's already up, I think about 12%, probably add another percent today. Silver's up even more today. So that's been a really interesting thing to see. And then, just with fixed income, it's at the bottom of our rankings, but it has had a great start to the year. The aggregate index is up about 1% already. And most of that's, we've had yields come down, a decent amount, kind of from the beginning of the year. But all the major bond classes, or most of the major bond classes, are outperforming the index, except for some of the less risky variants like money market and short duration treasuries, which is good to see. We want this asset class to do well. It's so important to so many people. But we'll just have to see how it goes. Like I said, it's still last place in the rankings, but we're hoping it can start to move up some.
All right, gentlemen, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.